positively generating cash and covering the dividend comfortably. So very pleased with that as a solid foundation, and as I say, makes it a very attractive entry point at the current share price.
Hello, you're watching Proactive. I'm joined by Next Energy Solar Fund Investment Director and UK Legal Counsel, Stephen Rosser. Stephen, very good to speak with you today. Could you take us through some of the highlights of your interim results?
Great to be here. Thanks for having me. Yes, very happy to. So the main highlights for the period, it's been a period of solid progress for Next Energy Solar Fund. Over the period, we generated across the portfolio around £45 million worth of cash from our almost 600 gigawatt hours of clean electricity production. We've maintained our target dividend for the full year of 8.43 pence, and we expect to be around 1.1 times cash covered there, despite some slightly less than optimal generating conditions over the period, driven by a combination of the weather and some outages on the electricity networks in particular. Our dividend yield is around 11%, which is one of, if not the highest in the FTSE 250, which does make the vehicle a very attractive entry point for investors.
What actions are you taking to narrow the discount, Stephen?
We're a very, very active manager, and as we've communicated previously, we have embarked on a program to recycle capital from some of the more mature investments in our post-subsidy solar portfolio. We had completed two of those phases previously, and we're very pleased to announce today the completion of the third phase. That's a really important component of our activity to manage the discount. We've also initiated a very meaningful share buyback program of up to £20 million. We're making good progress in executing that. And then we remain in active dialogue with all of our shareholders and investors to understand sentiment and how we can continue to evolve the portfolio so that we manage that discount and we drive back towards a premium.
You mentioned that share buyback program, Stephen. How's that going?
Making steady progress in line with the targets we set ourselves. So to date, we've bought back over 8.6 million shares for a total consideration of about £6.8 million. It's around in line with peers, and yes, just tapping into the liquidity where we see that in the market.
Could you run us through the capital recycling program and your latest asset sale that you mentioned?
Of course, yes. So as we announced last year, a very structured capital recycling program to unlock value from the investments that Next Energy Solar Fund had made in post-subsidy solar in particular. So the most recent transaction, which we announced this morning, is the completion of phase 3, which is the sale of Staunton. That's a 50 megawatt operational asset for which we received £30.3 million. That's a 21.5% premium to the carrying value. So that builds on the previous successes of phase 2, which was the sale of Whitecross in June this year, and the sale of Hatherden, which was a ready-to-build development project that we had developed within the portfolio towards the end of last year.
How do you achieve the premiums on these assets?
I think the key there is the fact that we are a solar specialist, so we understand where the value drivers are, and we're able to access those to unlock different components of value for different projects at different phases of their life cycle. So picking up on Hatherden, for example, I mentioned that was a development project where obviously there's more flexibility to optimize the configuration of that project. We had originally conceived that, for example, as a 50 megawatt project. We're able to redesign it and sell it as a 60 megawatt project with rights to install a battery, and also had secured a contract for difference there as a revenue stabilization mechanism, which drove a very attractive premium to the capital that we'd invested to develop the project. Whitecross, slightly different, was further on in its journey, had recently been constructed. The key value drivers there were making sure that we had a very clean build, so making it a very attractive asset for the market and for the buyer that eventually took it on. Also, securing the contract for difference there certainly helped with revenue stabilization. There's proportionally less that one can do for assets like Staunton, which has been operational for a little bit longer. But obviously understanding, where the pockets of capital are in the market and what drives value for those buyers, and bringing that transaction through successfully, through which we achieved that 21.5% premium to the carrying value, as I said.
What does the future market landscape look like for solar and energy storage given the government change?
I think very positive overall. We've seen plenty of positive news and momentum from the government, some very clear commitments to achieving clean power by 2030, and we're very excited to see the roadmap that is soon to be published by the Solar Task Force and the various consultations and other engagements with government as to how we will achieve net zero over the years ahead. There's also other reasons to be positive with some base rate cuts that we have seen over the period, and we expect the outlook there to trend downwards over time, perhaps not as steeply as some others might have assumed, but certainly some reasons for optimism in that space. And we are starting to see early signs of capital coming back to infrastructure, and particularly coming back to renewables after a period of hiatus. So plenty of reasons to be positive and plenty of potential within the sector to really drive value for shareholders, particularly for NESF through the proprietary pipeline of projects that we've developed and that exist within the fund, where we have maintained flexibility as to how we bring those forward when the time and the conditions are right to do so.
You mentioned that 11% dividend yield that NESF currently offers. Why should investors look at NESF?
It's a fantastic value for investors at the moment. It's high yield, and we firmly believe that the discount in the share price to the net asset value isn't justified. It's a physical portfolio of assets that's performing pretty much in line with how we would expect it to for this stage of its life. It's positively generating cash and covering the dividend comfortably. So very pleased with that as a solid foundation, and as I say, makes it a very attractive entry point at the current share price.
So what's next for NESF then?
So maintaining our focus, actually. So continued capital discipline in terms of our capital structure, continued discipline in terms of our allocation of capital, focusing on completing the remainder of the capital recycling program that we have talked about, and we're actively mobilized on what will now be phase 4. So we'll be looking forward to updating the market on that in due course. We maintain our focus on cash covered dividends and the progressive dividend policy that the fund has there, and as I say, maintain our target at 8.43 pence for this year, and expecting to be 1.1 times cash covered, notwithstanding some of the more challenging generation conditions from earlier this year.
Well, Stephen, I hope you'll keep us updated on all that progress. Thank you very much for taking the time today.
Thank you very much for having me.
That's Next Energy Solar Fund Investment Director and UK Legal Counsel, Stephen Rosser.